On today's episode, we are going to take a look at two growth stocks that took a nice beating. Like always, for each stock, we're going to take a look at things like technicals. We're also going to try to understand what they do and look at their fundamentals. The first company we are going to look at is Beachbody. This is a recent SPAC. Most of you have heard of them. They are traded under the ticker BODY. So we're just going to do a quick breakdown. But this is the fitness, I want to say one of the fitness giants right now, especially after the SPAC merger. So they do stuff like online streaming for video streaming if you want to work out. They also have the nutrition portion of their business, and they also have equipment to sell like bikes, right? So right now, Beachbody is now traded under the New York Stock Exchange as ticker BODY. On Friday, this stock really took a beating. So right now the stock is sitting about $9.94. If for those investors that picked up in the bottom, you're already up 8.4%, so congratulations. But we can see from its 52-week high, this is one where in early February, when the whole SPAC kind of industry was going crazy, or investment took a nice rally up, it is down about 36% from those levels. If we, like I mentioned, right, Beachbody is a merger of like three companies. It was Beachbody, Mix Fitness, and OpenFit. So they do the live streaming, like I mentioned, they do fitness, and they also have equipment to sell. So Beachbody, they did kind of give us on May 19th of 2021, the first quarter of results pro forma, and they had total revenue of $243 million. This was up 43% compared to the same time last year. So huge growth still for the company. Nutritional and other revenue was up 23%. Digital revenue was 56% increase. Connected fitness revenue was more than 20 times. Some other cool things in form of total subscriptions, they have $3.2 million at Beachbody, which saw a 39% increase compared to the same time last year. And it is a record for total subscriptions. So people are still purchasing. I am on their program, right? It's a cheap plan. I want to see it. It's, I think for like $30, you get it for like 3 months. Pretty cool. 95.8% month-over-month digital retention. I do believe it's because it's very cheap at the moment, and they more charge you on a quarterly basis. So it's not that's the plan I chose. So it's not as heavy on the wallet. They did see 35.1% daily active users and monthly active users increase by a good portion. So overall, they're seeing strong results even now as things are opening up. I do believe it's going to be very important to see how these upcoming quarters, now that stuff are really opening up, people going back to the gym, or are they still doing online type fitness? Right now, they have sold, for this quarter, they sold 11.3 thousand connected fitness equipment bikes sold by Mix, one of the companies they merged with, versus about 1,000 a year ago. Again, this is another thing we're going to have to see how that is progressing in the upcoming quarters. Is this slowing down? Is it still increasing? Is there still huge demand? But overall, the company looks pretty strong in form of growth. The valuation at about $10. Normally you can see the market cap on Google, but because it is a recent merger, it hasn't updated properly yet. So the pro forma equity is about $3.4 billion at around $10. And guys, let's take a quick listen to today's sponsor, a great reason why I'm able to provide so much content to you guys for free. Also, make sure to hit the thumbs up and the subscribe button if I am providing value to you. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You guys know I love finding new investing tools and resources to help me scout out new growth stocks. And right now I have a discount for one of my favorite services The Fool offers. Through the Motley Fool Stock Advisor services, you get access to a ton of expert stock picks. Every month you'll get 2 new picks that are aimed at growing your wealth and to help you realize your financial goals. Stock Advisor's average stock picks have done amazing returns. If growing your money is something you'd like to do more of this year, you can visit fool.com/Jose Najarro or click on the link below for access to my special offer and decide if the Stock Advisor is right for you. Thanks again to the Motley Fool, and now onto today's video. And one final thing I want to take a look at Beachbody is just their overall fundamentals, right? Their overall adjusted EBITDA, they are expected to be profitable. They were profitable beforehand for the previous years of the combination. For 2021, they're expected to be actually negative in adjusted EBITDA, but then after that they are exceeding to see a nice increment. Obviously, 2025 is too far from now, but I'm liking that previous to the merger, they were already adjusted EBITDA. Now they are expected to be there by 2022 as well. They do mention a good reason for 2021 expected to be negative in adjusted EBITDA is due to the fact that they have so many new programs that they have to spend money on linking everything together, on making everything merges in form of software, in form of platforms, in form of technology, and that takes money. But after that, those implementations of having everything together will be a huge driving force for the company. The second one we are going to take a look at is Apps. This is currently Digital Turbine and is traded under Apps. This is pretty much in the ad tech market right now. Definitely a very, very popular market, but the stock price has taken quite a beating. I don't know why I didn't have it open, but Apps right now is down 12.75% today. And we can see from the past year, from its 52-week high closing, the stock is down about 28%, 27.94. It currently is a super small company, right? Market cap of $6.37 billion. So digital apps, they have pretty cool markets. So the easiest way to explain them is they have two main markets. First is for the advertisers and publishers. If you want to monetize your app, if you want to get your kind of ads in the proper platform, Apps can help you with that. The second thing, they kind of work with OEMs for operation and device manufacturers. So let's say you are someone who sells TVs, or someone who sells any type of product from cell phones, anything. You know, when you open up the application, when you start off that equipment, that device, it starts off with some applications already. Some of those applications are like games or other apps. Providers, apps pay those OEMs to kind of have those apps with them. So Digital Turbine helps you kind of with that partnership. Not only that, right? Apps, I believe, has been very, very innovative, and they are doing plenty of acquisitions in the past few years. Just in the past 6 months, they've purchased, I think, AdColony and Fiverr. Again, ways to continue to grow their overall market. Here we can see Appreciate, which is also dealing with the ad tech market. They have AdColony here, very similar as well, and Fiverr. They all kind of hit the ad tech market and are all great within themselves. I think Digital Turbine is just becoming one super monster at the moment. If we take a look on May 25, they did, like I mentioned, acquire Fiverr, and this is again helping them lead the mobile advertising monetization platform. Then on April 29th, they completed the acquisition of AdColony. This is just in a matter of not even 4 months from 4 months ago. So two great acquisitions in my ability, and I'd say that in my thoughts, and I do believe Apps is gonna continue to provide strong results for investors in the long term of things. This is both of these I don't have in my portfolio, but I'm not gonna lie, they look somewhat attractive right now. So if we take a look at the most recent earnings, which they reported on June 1st of 2021, revenue growth was 142% compared to the same time last year. Full year revenue grew 126%. A good portion has to be due to the fact of all these acquisitions. For the upcoming quarter, they are expecting a lot of revenue compared to previous quarters. The main reason they're seeing this huge growth in revenue explosion, I want to say this is insane amount of revenue, quarter over quarter, is due to the fact of these acquisitions. And we can see they are definitely making great moves for the company in form of fundamentals. They are also non-GAAP adjusted EBITDA profitable, which is great to look at. Now, if we take a look at fundamentals, Apps is expected to grow 31.5% on average for the next 3 to 5 years. They are GAAP profitable, and they are positive in cash flow from operations. That's what I like to see. Fundamentally, in a great place. The only thing I want to say I'm not a fan of right now for Apps is their balance sheet. They have about $38 million in cash and about $15 million in debt. They are net cash positive, so that's good. But I wish they had a little bit more cash at hands and a little less debt. Pretty much no debt. After the acquisitions, especially the most recent one that happened during this quarter that they have yet reported, these balance sheets could change. I wouldn't be surprised if in the upcoming days, in the upcoming months, or in the upcoming quarters, Apps does another form of offering to just build up that cash position. If it does, I would understand it, but I want to say that's one of the biggest risks that comes with the stock. If we take a quick look at technicals, let's start off with body. Definitely not overextended. Anything around $10, I want to say, has a lot of risk eliminated. Obviously, now that it is post-merger, it can obviously go down way below $10. We've seen a lot of stocks doing that. But the overall market that they're hitting, I want to say the biggest risk is how this upcoming quarter, especially quarter two, or this upcoming quarter that will be ending in June 30th, will do. Are they still seeing improvements in numbers, or are things slowing down? And I think that would be the biggest impact. But overall, if one is kind of bullish in the exercise online market, Beachbody is definitely a business to talk about. Apps, on the other hand, Apps is definitely not overextended, especially after the nice drop down that it saw today. I want to say this is actually looking pretty good, nowhere near overextended, sitting at great volume areas. So if I wanted to increase into the ad tech market, Apps would probably be one of the companies I'm looking at. And this one actually might make my list of the top 4s I'm planning to buy this upcoming week. So take care, guys. That's it for today's episode. I hope you enjoy it. Have a good night and have a good, happy 4th of July weekend for those here in the United States. Peace out and see you next time.